All right, everybody, welcome to the Foundations and Essentials module. This module is basically for new and beginner traders, struggling traders, but it's also if you want a refresher, and we're going to be going through basically the key concepts and very important concepts actually that are in trading, but they're very foundation level, not anything complicated, but it's a good refresher no matter how much time you've been trading for, how much you know. Even for me, as I'm recording this, it's always a good refresher no matter how good you are as a trader, but it's directed towards new and beginner traders. So let's get into this. So as you guys already know, the PDFs will basically summarize what I'm going to be talking about, basically a summarized version of it. So you can download the PDF. It's right below the attachments, right below the WAP, in the module. So you can download it and they can help you out. But let's get into this. So thing about this is, let's get into it, is the fact that trading is simple. Oh my God. Okay. Trading is simple stuff, all right? It really is simple stuff. You do not want to overcomplicate it. Just don't overcomplicate trading. It really is as simple as price going down, it going up, down, up, down, up, down, up. And we are just clicking a button. You want to get this through your head that it's simple. Don't overcomplicate it. Don't become afraid of it. It really is just as simple as you're pressing a button given certain conditions that arise. So that's really what it is. We go here, long, shorts, and futures basic. Longs is you believe that the price is going to go up, and so you profit if it rises. Short is that you believe that the price is going to go down, and so you profit when it falls. So let me go here and I can give an example. Okay, right now the market is closed, so can't exactly place an order, but for example here, let's say I wanted to go short. Now remember, short means that I profit when the price goes down. I'll get into the stop loss and stuff later, but boom, then I just press sell. It really is that simple. You're just looking at this and I'm going to sell. Boom. Of course, I don't have, I'm not going to trade right now, and you get the point. This is just for explanation. So investing and trading are two different things. Investing is spot, when you're actually buying and you're holding onto the asset for a long period of time. That's investing. Whereas trading is you are doing it intraday. That's, at least for my model. There's swing traders and scalp traders as well. Swing trading is basically you're doing it over multiple days, and scalp trading is when you're doing it in basically minutes. Overall, I'm an intraday trader, and the module you guys are going to learn, the market setup model, is a intraday trading. So everything's going to be closed within hours max, like, you get the point, but we're not going to get into that right now. So futures. What exactly are futures? Okay, so this is futures, ES and NQ. That is the pairs that we're going to be trading. They're two correlated pairs. So what that means is that ES right here, ES is micro, E-mini. That's not ES, that's NQ. Let me just type it up there. This is TradingView, by the way. TradingView is completely free charting software. So we'll get into that more, but it's completely free. You can literally open up right now. But this is ES. ES long form is micro, E-mini, S&P 500 index future. I'm sure some of you guys probably heard S&P 500. A lot of people, when they talk about investing, into long-term Roth IRA, some of the shares in it are S&P 500, not exactly shares, it's an index. So what it is, it has the top 500 US companies publicly listed, and it's an index of those companies. So, and then that's that, and then NQ. NQ is basically NASDAQ, and that is the top 100 companies in the US, but tech companies, top 100 publicly listed tech companies, and that's the NASDAQ. And those are the two assets that we'll be trading. So they are correlated, and what that means is they basically move the same way. You can see here, just looking at this, you can see that, we went up, down, and everything basically looks the same. Two up candles. Okay, maybe I should actually reset this to this, just so you guys, because just so it comes to you, not as what I have set, but as the defaults. This is how it'll look to you guys. I'll also take off the indicators actually. But yeah, basically, up candles, down candles, up candles, down candles. up, 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 up. You can see we have like 1, 2, 3, 4, 5, 6 up candles. Everything looks practically the same, and it actually is the same. That is what it means correlated assets, and that's what we trade. So ES and NQ, there's tick size, so each tick 0.25, tick value 12.5. You really don't we don't need to get into this. It really isn't that important. Even me, I don't have this memorized or anything. No one really does. No one that I know really knows all of this too hard. And even if they do, it doesn't really separate you to become a better trader. It literally is just tick size, and yeah, we trade in lots, so I'm not going to get into that right now. Now, time frames. 1 minute, 5 minute. Use this 1 minute, 5 minute, 15 minute, 1 hour, and 4 hour. Those are the time frames that I use in the model that I trade, in the setup that I trade. So you can see here, this time frames is all here. So 4 hour time frame. What exactly is a 4 hour time frame actually mean? It means that each candle here, each candle is just indication of 4 hours. You can see I'll actually change all of this to 12 hour time, so it's easier because come on, everybody likes 12 hours instead of 24 hours. But you can see 9 p.m, 10, 11, 12, 1. 4 hours later, the next candle. And then this one is currently market close, so we don't talk about that. 1 a.m, 5 a.m, 5 a.m, 9 a.m. Every candle represents 4 hours. So that's what it is. That's the 4 hour. We go down to the 1 hour. What happens now? That 4 hour candle is now split into 4 1 hour candles. It's just fractal. Time is always fractal. Price is always fractal. Everything's just in fractions basically. 15 minute. Now what's 15 minute? 15 minute is 4. 4 15-minute candles is a 1 hour candle. Drop down to the 5 minute. 5 minute, 3 5-minute candles is 1 15-minute candle. And then for the 1 minute, 5 1-minute candles is 1 5-minute candle. 5 minute, 1 minute candle. 5 1-minute candles is 1 5-minute candle. Yeah, I said that right. Literally, as you scale up, that's what it's called when you go into the high time frames, which is 1 hour, 4 hour. You're looking at a broader view. Scale down, you're looking at a smaller view. Pretty simple stuff, don't make it more complicated. And if it is, pause the video and go back. All right, now that we've covered time frames, we will cover candle structure itself. So let's just go into this candle here. It's pretty easy to see. You know what? I'll only have one chart open. All right, so you can see this candle. This is the candle we're talking about here. This candle here, this one right here. This candle you can see is one candle, and we're going to be going through everything in the candle. So this candle opens at 9 p.m. on Friday. Now this is Sydney time, it's not New York, but that doesn't matter. You'll still understand everything. So this candle opens at 9 p.m. Now this right here, this right there, that is the opening of the candle. But why do I have Grammarly? Why is Grammarly there? This right here, which is 6794.5 is the opening of the candle. That is where the candle opened. This wick, this is called a wick. This the green part, the blob, is called the body. This is called the wick. The wick, like a candle, like an actual candle, the wick, and then you have the body of the candle, like a real candle. Just think about a real candle. So this right here is the low of candle wick. That is the low. That basically means price went here but then dropped here. It went to 6794.5, but it dropped to 6788.5. That is the low of the candle. Now this olive is the body, as I told you. And now let's go higher. Same thing. What would you think this is then? Closing of the candle. Closing of the candle right there at 6829.5. And of course, yes, this is the wick. Wick what? Wick high. This is the wick low, so this is the lowest point in that 4 hours. Since we're on the 4 hour time frame, remember, this is the lowest point, and then this is the highest point. That is the wick high of the candle. That is the highest point that price went to. Now, aligning this with multiple can't speak, aligning this with multiple candles. We have this candle, the low here, opened here. This candle at 5 p.m. 24 October opened here. It went all the way down here, and then it went back up all the way there. And then it closed there. This candle closed there. What happens here? This one, bullish candle. Bullish means green, bearish means red. Bearish is just price going down, bullish is price going up. Right here, this candle here, this opens here, goes low over here, and all the way up here is the close. Before actually first, it goes to the high and then it closes. Now let's actually get bearish candles into this. Bearish candles being red candles. Now bearish candles, since they're bearish, they don't exactly have the same opening and closing. Since it's a bullish candle, it opens at the bottom. A bearish candle opens at the top and it closes at the bottom because the price is going down. And so we have this bearish, the price opened here, the candle opened here, it went all the way up here to, I'm talking about the 1 a.m. candle right here, 23rd of October. It went all the way high up here and then shot down all the way down to 6691 and it closed right there. And then we opened for the bullish candle right at 5 a.m. We opened for the bullish candle. Bullish candle went all the way down here, went all the way up there, closed there, open, down, up. Down and up is the same as saying high. Low and high, close, open. See, open at the top for bearish candles, open at the bottom for bullish candles, because bullish is price going up, bearish is price going down. And so price can only go down from a higher point. Yeah, so that is time frames. We can go here for a visual representation of everything that I just said. As I said, bullish candles, open, close, high, low. We have the wicks of the candle like a real candle. Just visualize it, like genuinely. Just visualize this. Just visualize this. You see this? Forget about the fire. Pretend the fire was never there. Okay, right here. This is the wick. This is the opening of the candle. This is the high of the candle. And then this is the close, considering it's a bullish candle. All right, so that's candles. You guys can screenshot this, whatever. Now let's go into this. Technical, fundamental, and psychological analysis, or mental analysis, both the same thing. So what is technical analysis? Technical analysis is literally, let me delete this first. Technical analysis is literally just looking at the charts and understanding just from looking at the charts, what am I going to do? Am I going to go long or am I going to go short? That is all technical analysis is. It's basically looking at the chart, maybe pulling up some indicators. This is not my strategy, but just, random indicators, RSI, Bollinger Bands, whatever. All right, we can just search up indicators here. RSI, we're right here. This is the low, boom, long, something like that. Technicals is literally just drawing stuff on the chart. And from that, okay, I want to go short. That's what technical is. It's just analyzing the chart itself and then basing what you have learned from that on your decision. Let me actually delete these indicators because we don't need that. Oh, okay. I haven't used indicators for so long that I got that wrong. All right. So that is technical analysis. Literally just looking at the charts, drawing lines. And that's basically the model. The model that I teach you, the Market Surfer, is just the technical analysis part of everything. Next is fundamental analysis. Fundamental analysis basically means looking at macroeconomic influences in the market that could fluctuate price. So Forex Factory is basically what I use and what basically every trader uses for fundamental analysis. So you can see here, fundamental analysis is for the past week, tells you exactly what is going to happen. You can see that fundamental analysis is about macroeconomic influences, basically news, any employment data, NFP, CPI, unemployment claims, Trump talking and shooting the market down, anything like that will be captured here. Sometimes Trump talking is captured on Yahoo Finance, so that's another good website, completely free. But most of the important stuff is right here on Forex Factory, completely free. So we have fundamental analysis. You want to know fundamental analysis. I'm going to be talking about it more on the Market Surfer module, but fundamental analysis is very important. You want to know what's actually happening in the macroeconomic condition, because that could fluctuate and potentially stop you out of the trade. fundamental analysis, it's very important, all right? You need to know news because news inflicts volatility. It inflicts volume. Right here is yellow folder. Yellow folder, I'm going to go through this very quickly. This is not, a forex factory tutorial or anything. Yellow folder news basically means that it is, it's yellow folder. It's not too crazy. Really, like I'm just trying to make this simple as hell. Orange folder, it's a bit more, it's a bit more influence. The influence of the market is going to be a bit more, but the biggest ones is red folder, CPI, NFP, FOMC, sometimes Trump speaking or Powell, Fed chairs, all that stuff. That's red folder news. Red folder news has a big influence on the market. So right here is yesterday at 8:30. Let's check this out. Yesterday at 8:30 is this. Yep, this is New York time. So I'm going to have to switch this here to New York. Yesterday at 8:30. 8:30 yesterday. All right, so right here. 8:30. Boom, 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 boom. $8.30 right here. You can see this is what I mean by macroeconomic is very, very important. You can see this is 8:30. Look at what was happening. Look at what was happening. Look at the moves that we had. It was slow. It was nothing crazy. Look at this. Look at this. It was just normal market. And then look at this absolute crazy candle here. 8:30. Because of news, because of red folder, high impact news, that's what it's called, we had a big influx. Now imagine if you were short. Imagine. So it's very important, basically. News, very important. Fundamental analysis. That's what it's called, but no one actually calls it that. Just say news, it's fine. Psychological analysis, now that is literally just trading psychology. Your mental state when you're trading. And that is we're gonna go through that completely in the psychology module. Next, let's get into this. So all of this, of course, here. Now let's get into this stuff: risk to reward and win rate, as well as long and short. I've already gone through long and short and what that means, but the long tool is this, short tool is this, and it also tells you the amount of points that your target will be. And the amount of points before you get stopped out. Stopped out means as soon as price goes there, you're automatically out. Loss, TP, take profit, you automatically get out at a win. Break even is just break even right here is when you make no money. So risk to reward and win rate. What exactly is risk to reward? What exactly is this? Now, when we go back here, you can see risk to reward ratio 1. One risk to reward means that I am risking, for example, $500 to make $500. That means a one risk to reward. If I'm risking $500 to make $1,000, that would be a 2RR, which is risk to reward. And that means that I'm risking 500 to make 1,000 if the trade plays out. And then, of course, there's 3RR, which is literally 500 to 500 I'm risking to make 1,500. It's literally you just multiply whatever you're risking by the points that your risk to reward is. That's risk to reward. Now, win rate is as it is. It's just how much times you win. But the important thing and why I'm actually talking about this is because with my strategy, your risk to reward is 1 to 1.5. Probably doesn't sound very crazy, but as you guys have already seen on my YouTube, it works. And the reason why 1 to 1.5 works is because the strategy has a high win rate. A lot of people have a high RR, but they have a lower win rate. So they lose, and then they win, make back about 3 of those losses, and maybe I'll break even. But with this, you're getting a 1 to 1 or 1.5, 1 to 1 to 1.5 risk to reward. And so you're risking the same amount that you're going to make. But the probability of you actually losing is much less. And so you can actually risk heavy when the time comes and when the opportunity arises. Not going to be going through more on that because that is, market surfer module. Let's get into some key concepts now. All right. Some key concepts of trading. Let's get into it. FVG right here. FVG. Okay, this is a bit too much. FVG, fair value gap. What is an FVG? An FVG is an imbalance between buyers and sellers that creates a gap in the market. Right here is an FVG. What is this right here? We're in the 1 minute chart right now. So you can see from here to here, we have a very big gap. You can see, look at this gap right here, right? So the FVG is basically the previous, the end of the previous candle to the start of the next. Boom. That is your fair value gap. And it literally is just an imbalance of buyers and sellers. Buy side imbalance, sell side inefficiency, which is a bullish fair value gap. And bullish fair value gap is just, it's bullish. Bearish fair value gap is sell side imbalance, buy side inefficiency. This right here is a bullish imbalance, a bullish fair value gap, imbalance, fair value gap, whatever. Vice versa. I mean, it's the same word. Bullish imbalance. What FVG actually is it indicates where there's a lot of buyers. So here there's a lot of buyers, which is why there was a gap in the market. And so what happens with an FVG is most of the times, one of the reasons that the market moves, I'm not going to be getting into this too much because that is the market 7 module and the logic behind the market 7 module especially. One of the reasons the market moves is to rebalance two fair value gaps. Boom. What is happening here is right here, we have an imbalance from here to there. We rebalance to the fair value gap because that is one of the reasons the market moves. If you want to get more detailed, it's just because orders are filling, people are getting liquidated. You can search that up. But boom, right here, and then bang, it's getting rebalanced. What is happening here? The exact same thing. FVG created, market rebalances to it, liquidates, and basically stops out people who went long, over here. I'll just draw it, and then it goes back up, but I'll draw what I mean. For example, people who went long too early, they got stopped out. Market liquidates. Liquidates basically means your position has been automatically stopped out and money is being made. So that's an FVG. Next is trends. Trends is literally just this. Right here is a bullish trend because price is going up. Why is it a bullish trend? Is because we're having a high here. Here we created a high. And then what happened? We created a higher high. Here we have a low. What happened? We created a higher low. That indicates that price is continuing higher. If you want to, yeah. So you can see, a pretty good example. We can go into the 5 minute because it's a bit more easier to see. Right here, it's pretty simple. Boom, created a high. What do we have here? We have a higher low. Created a high here. We don't actually have a bullish here because we failed to create a higher low here, but then we're still ultimately going higher and creating higher highs and higher lows. And of course here, same thing happens. We don't exactly have it completely, but you get the point. It is that. And then the bearish trend is the same thing. Oh, wrong way. Same thing, but in the opposite direction. Like that. We're having lows, lows, lower lows, lower lows, lower lows, and lower lows, lower lows, lower lows, and lower high, lower high, lower high, lower high. So when someone says we're in a bullish trend, that's what they mean. Displacement. Now this right here, like this candle kind of is pretty nice because it's basically just giving me everything that I need in this one page. I don't have to find anything else. Displacement is just price going up very quickly or going down very quickly. With a lot of the stuff that I'm saying here, when I say going up, it's vice versa for down as well because, it's the market. It's bullish and bearish. So right here, what happens is price goes up very quickly. This here is called a displacement candle because it went up very, very quickly. We had a very strong move up. And to actually measure how strong it was, we can see 24 points. Now, some of you may not, understand the significance of that, but literally 24 points in 1 minute, because that's it's a 5 minute candle. Let me actually shorten down to the 1 minute. In 1 minute, we went 33.25 points. 33 points in 1 minute. And how much is this? 27. We did much more than 27.25 points. We moved, by we, I mean the market. The market moved 27, I think it was, points in one. Oh wait, no, it wasn't 27. It was 33 points in 1 minute. And look how long this took. 16 hours. It took 16 hours to move 27 points. But in 1 minute, because of red folder CPI macroeconomic news, in 1 minute, we just completely cooked what we did for the past 16 hours. Now, when I say we, once again, I mean the market. But yeah, that's what displacement is, a very strong bullish or bearish candle. Now, it doesn't have to be this strong. All right, so just to help you guys here, we have the candlestick. Here, most bullish are the ones, basically anything that has very strong body that is more bullish than something else because there's more displacement, because there's more orders there. So you don't have to like be that like technical with it, but literally something like this is the most bullish, something like this is the most bearish because the full body is there. The more that the wick is there, the less the less influence that position has. Here, there's a bit of wick, it's all right. But here, there's quite a lot of wick. It's a neutral candle. Here as well, it's strong, but it's not strong enough. It's not too much of a displacement candle, which is a strong candle in any direction. Literally that simple. You don't have to complicate it more. If you guys want, screenshot of this, strength of candlesticks. We can go back here. A displacement candle, yes, that's a pretty, obvious one. But something like this, like a lot of these stuff can be displacement candle. Displacement candle is literally just price going up in a direction strongly. Let me actually do this. So right here, what is this? Displacement candle. Displacement candle. This is kind of not really. And then you see this is not a displacement candle. This, like anything that has a lot of wick, really isn't a displacement candle. This is kind of a displacement candle. But like the ones with a lot of body, like this, that, and same with bearish, same thing. Bearish ones with a lot of body, something like this, that ain't displacement. That all of those are displacement candles. All right. Next is CISD-OB. CISD is basically when manipulation has happened. Now, what manipulation is right here. Okay, so this right here is sell side liquidity. Bro, Grammarly, oh my days. Sell side liquidity. Let me just actually make this to the right. Right. Boom, here. All right. So sell side liquidity. Once again, liquidity, it's just already, market just making money is a fancy term for liquidity. But sell side liquidity, why? Because when people go long, they have their stop losses here where they automatically get out. What happens when it actually gets taken is that all those liquidations are happening and automatically their positions are getting sold. Sell side liquidity because you're long and you're getting automatically sold. Buy side liquidity is just like it's just a range. I'm not going to go into this too much, but on just a range here, boom, we have buy side liquidity, swing high of the range, swing high, low, high, high, low. That right here, this right here is buy side liquidity. So buy side liquidity, BSL, and that means literally why it's called buy side because people have their stop losses right there. TPs whenever, but whenever that gets hit, which got hit like right over here, what's happening is people who went short, they're automatically being bought at a higher price. So they're not making profits. Or they're making heaps of losses, that's the point. The point of that was to understand CISD. CISD is a change in state of delivery. It literally just means that the market was once bearish, but now is bullish. So we're the delivery of the market is changing. So here we have sell side liquidity. Well, the swing low is actually not this. The swing is actually here. That was also sell side liquidity, but as time went on, it got liquidated. But yeah, sell side liquidity. A CISD is a series of bearish candles. We have it right here. CISD, price flips and internal liquidity is swept. That's what it is. So here is a series of bearish candles that liquidated previous liquidity levels, created this sell side liquidity, but we went higher from it and we closed above the body of this candle, not the wick, the body. And because of that, boom, we have a bullish change in state of delivery. We were once bearish, now we're moving bullish. Something like this, bang. That is CISD. That is one of the confluences that I use to actually enter my trades. Now, OB is the same thing practically, where it's a series of bearish or bullish candles, but OB is just order block is without the internal, without the internal liquidity being swept right here, which is the buy side liquidity, sell side liquidity. You don't have to say that every single time, literally just internal liquidity, that's all. But right here is an order block. This here, I'll actually do a bullish one just so it makes sense on both ends. Right here, a bullish order block. Right here. Remember, this is a series of candles. We have a series of bullish candles here. So this here is the order block. Boom, at the body of it. So that is the order block. Now, this isn't the CIST because we have failed to actually liquidate this. But yeah. Boom, order block right here. As price goes below it, it is expected to go lower. That is what an order block and a CIST is. Next, right here, a concept summary of it. This will actually help. And you can see once again, manipulation. This is the CIST, order block, order block, order block. And remember, order block can be one candle as well. CIST can also be one candle. So yeah, CIST, zone of bullish bearish candles, important. Boom, boom, boom. Next, I'm going to briefly talk about this. Why is Forex Factory still here? Why the market moves. Now, the market moves for 3 reasons. There's actually a 4th one, but I'll get into that in the market 7 module. 3 key reasons is rebalancing to inefficiencies, which I touched on before. High time frame gaps are stronger. So the higher time frame gaps here, we go down to 1 hour. 1 hour gaps are stronger. Let me get a nice example here for you guys. Boom. We have a gap here. Boom. Price is, of course, it's stronger in the high time frame because there is more orders and there is more orders placed to actually make that high time frame fair value gap in the first place relative to like a 1 minute one. So one of the reasons market moves, as we already touched on, rebalancing to these inefficiencies. So this right here is a bearish fair value gap. So we have buy side inefficiency, sell side imbalance. There's an imbalance of sellers. There's a lot of sellers, but there's an inefficient movement of buyers. There's not a lot of buyers. And so we rebalance doing it. We rebalance to fill orders, liquidate levels. That's one of the reasons that the market moves. We rebalance to inefficiencies, which is, just inefficiencies for that gap, same thing. And the second reason is we generate liquidity. This liquidity being generated, what is this liquidity? Buy side, where there's a lot of people who have gone long, their stops are there. This right here, same thing, we are generating liquidity. That is one of the reasons the market moves, is the market goes towards where there is liquidity. Why would the market do that? Simply to make the most money possible. Because wherever there's liquidity, there's auto liquidation. Auto liquidation means people are automatically getting stopped out. And when people are automatically getting stopped out, the commissions are being made, the brokers are making money, and people who went in the opposite direction, of course, are making money as well. So we rebalance to this inefficiency. And we hunt, and we're generating liquidity, right? The market is generating liquidity as it's rebalancing to the inefficiency, and then it gets to the third one, which is hunting liquidity. I'm going to just get through the logic here again. We rebalance to, we're generating liquidity to do what? To rebalance to the inefficiency. Now we've rebalanced to the inefficiency, what will we do? This is not always in the same, I'm just putting it in order. We're rebalancing to the inefficiency. Another reason the market moves is to hunt liquidity. Hunt. Hunting literally just means they're getting liquidated. And so, something here would have worked. This trade would have worked. Next up, lads. Smart money technique. That's what I use, and that's what the continuation model is based upon, is smart money technique. And institutional traders are just big traders who work at institutions, banks, pension funds, hedge funds. All these guys are institutional traders. And so basically, smart money technique, SMT. What is an SMT? So I'm going to go back and pull both the charts at the same time. ES and NQ are correlating assets. So they move the same way, as we already know. But when they don't move the same way, that indicates that the hedge fund, the institutional traders, those who are making hundreds of millions of dollars per trade, they're moving their money. they're selling, they're buying. Something different is happening in the market, which is why there is a difference between the two correlating assets. There's a divergence in the correlating assets. Something is actually happening. Something different is happening. And so that is an SMT. So for example, if ES makes a higher high while NQ makes a lower low. So I'll go through it like this first. So ES, we make a higher high. Boom. But then NQ makes a lower one. When this happens, and so basically we've made a higher high here, high, but then we've made a low, we've made that high, but then a lower high. What is happening here is now that this pair, there's more money being allocated to NQ. Right is always, for me, my charting, right is NQ, left is ES. So on the right, there is more institutional traders going short, changing their orders from here to here, going short on NQ. That is why there is more bearish, indications happening as we have failed to make the higher high that ES made. And so now what is happening is this is the leading pair. It's the leading bearish pair. So it actually indicates that more money is going towards NQ to go short. And so that just means short confluences. Confluence just means it's just something to use that gives you more indication that, for example, a bearish trade is better, a short is better. That's a confluence, or a long is better, whatever. All right, so that is, I'll actually try and find an example here. I can just pull up my trades, but let me actually try and find an example here. It'll be easier probably to go in the 4 hour here to do this. All right, before I continue, I'm sure you guys, get this. And I'm just gonna switch it back to my actual template. Boom, market surfer template right here. That will be given in the market surfer. The colors itself looks so much more cleaner. And the thing is that it actually is better to use something that isn't green and red, because green and red, makes your mind think of losses and profits, and the psychology course is a module is a full-on yap about why that is so bad. So let me actually find a goddamn SMT, bro. Lock in. Like, where is this SMT, lads? SMT, can I find you, please? Need it. I need an SMT. So if it's equal, it's not an SMT. We have equal highs here, not an SMT. Equal highs. Boom, boom. Boom, boom, boom. Yo, I might just have to pull up my trade, bro. It's also 12:30, so I might be missing stuff. Like, it literally is 12:31. I might be missing something. Let me see. Oh, I think I found it. Yeah. All right. We have a high and then we have a lower high. But you can see, look at the left, on ES, we have a high and then a higher high. So we created a higher high here. Oh wait, magnet isn't on. And then we created a lower high here. That is a bearish SMT favoring NQ. That gives confluence that smart money is moving bearish. And what happens after that? Boom. And of course, it sounds a bit simple right now, but there's a lot of, this is the 4 hour chart. You need to be very precise with your entry, your stop loss, your TP, not getting stopped out earlier, getting liquidated. You know what? I will actually show one from a trade. All right, so this is a trade that I took and I got 978, made 978. No, God, what? You can see here we have an SMT. The dotted line is the SMT that I use. It's the way that I've used my, what? This line is an SMT, okay. We have an SMT, bullish SMT. Later on, I get along towards the target. Draw on liquidity is where the market is going. It is where the market is going to hunt the liquidity, because ultimately the market is going there to liquidate levels. And the draw on liquidity is practically your target. Where's the market drawing towards? It's like a magnet, I'm drawing you in towards something. I'm railing you in towards something. I'm reeling you in. That's a draw on liquidity. I represent my draw on liquidities from a yellow line. Might as well show you guys my trading ends. Okay, right here, you can see the draw on liquidity here is that yellow line. It's where the market is drawing towards, aka where the market is drawing towards, aka your target. Your TP level should be your drawn liquidity. Stop loss TP, you guys already know that. Now let's get into this, the source. Paper trading is the same thing as forward testing. Backtesting is backtesting. Evals, challenges, funded accounts, live accounts. All right. So forward testing or paper trading is just trading on a simulated firms on real market conditions. This is real time market, but the money you're using is all fake. So this is completely for free through TradingView. You can literally just do this by paper trading, connect, and boom. Oh, I traded on this. Yeah, boom. And now I can literally just, since the markets are closed, I can go into shit. Might as well go Bitcoin. And then just literally, it's on. Like it's completely for free. You get your take profit, your stop loss, boom, stop loss, TP, and you get to do this for free. And it also gives you a nice analysis, although you should be actually doing the analysis yourself. But yeah, I mean, not the analysis, the journaling yourself. Paper trading, that's paper trading forward testing. Back testing is going back to historical data. You can do this with TradingView as well. MES, bro. MES, lock in, bro. Lock in, bro. MES right here. Boom. So, backtesting is literally going back here, anywhere, historical data. You don't even you can literally just press this and then random bar. Will put you in to a random bar. Absolute random. Internet? Hello. Okay, my internet is cooked. My internet is cooked. I'll just select a bar so it doesn't cook itself. Random thing. And then what you do is you maybe just do this, and you just see, does your strategy play out? Does your discretion play out? And you can practice unlimited amounts of time. And then boom. This is absolute random trade. 1 RR, I'm telling you, 1 RR, bro. 1 RR. Imagine if I had a 2 RR stopped out. It's like 1 RR does save you quite a lot, but anyways. Backtesting, a really good website is FX Replay, completely free, and it gives you full on dashboard. It just gives you an entire understanding of where you went and actually have. What I used for this and what I do use always for my backtesting is FX Replay. It's because it actually gives you a very, very nice dashboard. Should be somewhere here. It gives you a very nice analysis of your trades, your win rate, your RR, total trades you took, break-even trades, account. It gives you everything very, very nicely. Very nicely. And for completely free is absolutely insane. So FX Replay, you can use that, pretty nice. Next is evals. Evals, prop firms. Prop firms is literally just they're giving you money. The firms are going to give you money after you've passed a challenge. They'll give you money. They'll give you 50K, 100K, 150K right here. All you have to do is just pass the challenge. You get the money. You get a certificate that, boom, you've passed, email, everything. And then you get the actual money. And with that money, you actually just scale it up. After 5 winning days, most of these firms have 5 winning days. Top Step, Alpha Futures, My Funded Futures. After 5 winning days, you get to cash out the profit that you make. You get to cash it out with literally a $49 investment plus the activation fee when you pass. So that's basically $200. For $200, you're getting access to 50. You're getting access to 50K, and you're getting a 20x return with the 1.5K withdrawal payout. That is absolutely insane to me. And to anyone, but that's a very strong ROI. But you only do evals. I'm going to go through this in the how to get funded module. You only do them when you've forward tested the market surfer, when you've back tested it, when you understand it, and when you have had green weeks, or else you're going to be paying them money. That's what's going to happen to me. So, everything is just experience. You have to do it only when you're ready. Next, so that's what it is. That's the eval. Once you actually get the money, once you get the account, that's called funded account. And then live accounts is when you use your own, do that again, when you use your own money. Your own money. Okay, so that's like later on. You can use your own money. And the good thing about that is that you don't have to, there's a lot of rules that go into funded accounts. There's a lot of rules, like, you can only take out 50% after 5 winning days, but only after 30 winning days, you get to take out it all. You get moved, you can't, you have maximum stop loss. You can't go below a, maximum loss limit. You only have a max level of position, and like max level of contracts, and there's scalability in the contracts. You have all these things. There's quite a lot of rules that you have to abide by. All the information right here. Yeah, you literally get to 10 to 30x ROI. That is absolutely insane, bro. 10 to 30x charting software. Now for journaling, Notion, I use Notion like I showed you. Google Docs is pretty nice as well. I also use Google Docs. You can use a physical notebook, if you like that. Charting, trading view, when to trade. Let's get into the source. Previously, I was trading random times. Basically the entire day I was on the charts, looking in the entire charts. I had alerts set. Just think about that for a second. The entire day I was on the charts, losing money. And that is why we trade ESNNQ, is because there is high volatility during specific times, during New York Open. Why during New York Open? It's because that's Wall Street Open, bro. That is the strongest stock exchange in the world, and we're also trading very strong pairs. ESNNQ, US top 500 companies, top 100 tech companies. There's 3 sessions: London, Asia, and New York. Of course, depending on your, where you live, it's all going to be at different times. But I have this on New York. New York session starts at 9:30 a.m. And so you want to be trading from 9:30 to 11 EST. That is when most of the volatility is. And that is when there will be the best moves with the model that I'll teach you. That is the time you want to be trading. Literally, that is the rule. Don't try and trade some other sessions. Before we get into that, you can see here, New York is green, Asia is blue, London is yellow. Which session has the most highest amount of moves? You can see here, New York, 51 points. This is just random, completely random. London, like 20 points. That's Asia, 20 points. London, 16. New York, always having the most amount of moves. New York, the green one, always is having the biggest moves. Of course, sometimes there can be, variations, but overall, because New York Open is Wall Street Open, it has the most amount of institutional traders there ready to help you just, ride the wave of institutional traders towards your TP. So, New York AM. That's New York AM, 9:30 to 11. New York PM, aka Power Hour. You should only be thinking about trading this if trading New York AM is 3 to 5 a.m., which I believe it is for New Zealand. I don't know any other country that has it, but New Zealand, I believe it's like some whack time. Australia is also pretty whack, but it's not as whack as New Zealand. So, unless you're trading between 3 a.m. and 5 a.m. New York AM, that's the only reason why you do not trade New York AM morning session. That's only when, because you don't want to be nocturnal and, cook your life, right? What you want to do is only if you're trading between 3 a.m. and 5 a.m. when New York AM is between 3 a.m. and 5 a.m., then switch to New York PM. Okay, this is actually written wrong, but it should be PM here. PM session, the afternoon session, which is Power Hour. Power Hour. It is the last hour of New York session. Power Hour is 3 to 4 p.m. EST. 3 right here to 4 p.m. Pretty nice longs. New York AM, pretty nice shorts. So that's what you want to be. Basically, trade New York. Don't go to Asia or London. Trade New York. Now, New York, of course, is 9:30 to 11. But I do hop on at 9:10 just so I can get some journaling, some pre-market journaling in and understanding of what the market price action is doing. So I do hop on at 9:10 EST, check the charts, prep the trades. Cool. Small opportunities for the other sessions. So that is basically the gist of the essentials module here. Trading is simple if you strip away the price movements. Like, don't try and complicate this. Like, that's a thing that I did at the start. I kind of was just bombarded with everything, and no one ever told me to just think of it simply. Brother, you are literally you're literally just looking at a chart, sitting down, looking at a chart, drawing lines, looking at some news, and then entering, and then literally just pressing a button. And then pressing more buttons for risk management and taking out the trade. That is all you're doing. Do not make this seem like you're doing something crazy, okay? You're not building a house, okay? You're not building a house. You're literally just doing some simple buttons, bro. This is what you're doing. I wish someone told me that, bro. I wish someone told me that at the start. So yeah, that's what you're doing. Just make that, put that in your head that is all you're doing. Make it simple. Strategy is replicable. Psychology is the hard part. That is so important. Psychology is the most hard part in trading. So this guide and the other modules is basically the shortcut I wish that I had. You will save months and months of trial and error. Journal every trade, review psychology, do all of that. And that's basically the gist of the beginners module. The essential and beginners module. Right now, I am tweaking a bit because, as I said, it's 12:50 a.m. So yeah, that's all. PDF is there, and I'll see you all in the next module.